All right. Hello, everyone. I am Shannon Ballman Theis, the Payroll Queen, and today I wanted to discuss something that I've seen happening in a bunch of different payroll groups or bookkeeping groups where people are blaming the payroll software for calculating federal unemployment incorrectly. And I just wanted to pop in and make this quick video and let you all know that the payroll software did everything correctly, probably. Because what I think is happening in the post where they think the payroll software didn't calculate the federal unemployment correctly is that those employers are in a federal credit reduction state, which a credit reduction sounds like it could be a good thing, but it is not. The way federal unemployment works is the standard rate is 6%. The discounted rate or the credit rate is 0.6%, but you have to do a couple of things to qualify to get the full credit. One is you have to pay your state unemployment in full and file the returns on time every quarter. And the other thing is your state can't owe their Title IX advance. So what the Title IX advance is that when unemployment is really high in a state, the state will borrow money from the federal government to pay their unemployment. And when the state can't make all their payments up, then what happens is the every employer in that state has a credit reduction. So I'm going to show you here real quick how to um, get the figure out what states have a credit reduction. And the November 10th is the deadline for paying the loans back. And if a state doesn't make the November 10th deadline each year, then the Department of Labor issues a credit reduction. The reduction schedule is 0.3% for the first year, and it adds another 0.3% for the second year and another 0.3% for each year thereafter. And the way that I always figure out who is possibly going to be a federal credit reduction state and who actually is a federal credit reduction state is I just go into my browser and type federal credit reduction state, which brings me to this page. And then you can click on FUTA credit reduction, and it brings you to the U.S. Department of Labor. And you can see the historical credit reductions or the final. The other option before November 10th is estimated or possible credit reductions for that year. But so we'll open this. This is going to be a Excel spreadsheet that is the final credit reduction states. So right now, the final 2025 federal credit reductions is California and the Virgin Islands. It looks like there might be more states. However, if we follow row 13 across, California has an outstanding is a credit reduction state due to outstanding advance, and that's at 1.2%. It does not have the 2.7 add-on. And then this add-on is the benefit cost rate additional credit reduction formula having passed the 5 consecutive January 1st with an outstanding federal advance. So but even though they did, they got a waiver, so they don't have the additional 3.4% BCR waiver add-on, repaid outstanding Title 12 advance before November 10th, 2025. No. So the final credit reduction for 2025 is 1.2%. And as we can see with Connecticut and New York, they did repay their advance before November 10th, 2025. So their credit reduction is 0%. And the Virgin Islands is always on this list. It has been every time I've looked at it. So hopefully this helps you understand where to go to find the federal credit reductions and what's happening. And the reason that the payroll software doesn't calculate any credit reductions is because traditionally, most employers meet their federal unemployment $7,000 wage base at the beginning of the year, and it will never be known before November 10th if a state is a credit reduction state or not, because the the states have until November 10th to pay back any advance. So there's not going to be a way for the software to have a crystal ball and know if a state is or isn't going to be a credit reduction state. So what happens is when you go to file your 940, your federal unemployment return, and sometimes you have to know, it depends on your software. Like the software I use, I need to know if they're in a credit reduction state or not so that I can mark that they are in a credit reduction state. But the software knows what the credit reduction rate is, and this year it's 1.2% because that's where we fall on the credit for how long California's had the 0.3 added to they're losing their credit. And then a Schedule A is triggered when you're in a credit reduction state. A Schedule A is also triggered when an employer is in more than one state. And then the additional tax gets added to the 940. A lot of what the full service payroll softwares will do is they'll say, hey, we reconciled this and you owe this X amount more. And what the not full service payroll softwares will do is they might not even tell you anything that there's an extra amount. You might catch it when you're reviewing the 940 and see that there's a balance due. So I just wanted to make sure that I put some of this information out there just in case you are trying to figure out why your clients or your own 940 shows a balance due. Chances are really good that it is not your payroll software's fault. It is the process, because nobody knows until November 10th. And sometimes we're supposed to know November 10th. There's been a couple of years where we haven't known exactly on that day. But we always know before December 1st. So just keep an eye out for the federal credit reductions I would say if for December, if you have clients in states that like California, Connecticut, New York, and the Virgin Islands are the four that are usually on the list, at least since recently, the last couple of years. And so I hope this helps. Definitely, if you have any questions, leave a comment below, and I will work on getting them answered. I usually a couple of times a week am answering all the comments on all the videos. So thank you and have a good day.